Welcome to my channel. The Caribbean is facing a new economic challenge. The region, known for its vibrant culture, stunning landscapes, and bustling markets, is now grappling with an economic storm that threatens its very foundation. In 2025, the Trump administration imposed tariffs on goods imported from the region. These tariffs were part of a broader strategy to protect American industries, but they have had far-reaching consequences for the Caribbean. This decision sent shockwaves through the islands, many of which rely heavily on trade with the United States. The Caribbean's economy is intricately linked to its trade relationships, and any disruption can have a cascading effect on its financial stability. The tariffs, a form of tax on imported goods, have raised prices for consumers and businesses alike. Everyday items, from groceries to electronics, have become more expensive, straining the budgets of ordinary citizens. They threaten the fragile economies of these island nations. Small businesses, which form the backbone of the Caribbean economy, are particularly vulnerable. Many are struggling to stay afloat as the cost of imported goods rises. The tariffs are not uniform across the Caribbean. Different countries face varying levels of tariffs, adding another layer of complexity to the situation. Most countries face a 10% tariff on all exports to the U.S. This has made it more difficult for Caribbean businesses to compete in the American market, leading to a decline in export revenues. However, Guyana initially faced a staggering 38% tariff. This exorbitant rate was a severe blow to the country's economy, which relies heavily on exports. This higher rate was later reduced to 10% after a 90-day period. The temporary relief was welcomed, but the initial shock had already caused significant damage. The reasons behind this discrepancy remain a point of contention. Some speculate it was a political maneuver, while others believe it was an oversight. Regardless, the impact was felt deeply by the people of Guyana. The impact of these tariffs is significant. The Caribbean imports up to 70% of its consumer goods from the United States. This heavy reliance on American products means that any increase in tariffs directly affects the cost of living. The increased costs are already being felt by businesses and consumers. From the bustling markets of Jamaica to the serene shores of Barbados, the economic strain is evident. The increased costs are already being felt by businesses and consumers. Small business owners are finding it difficult to maintain their profit margins, and consumers are cutting back on non-essential purchases. Basic necessities are becoming more expensive. Families are feeling the pinch as they struggle to afford everyday items. The rising cost of living is a growing concern for many. Essential projects are facing delays due to the rising cost of materials. Infrastructure projects, which are crucial for the development of the region, are being put on hold, further hampering economic growth. The situation has created a climate of uncertainty and concern. People are worried about the future and the long-term impact of these tariffs on their livelihoods. Caribbean leaders are grappling with the implications of these tariffs. They are holding emergency meetings and discussions to find ways to mitigate the impact and protect their economies. They are seeking ways to mitigate the damage and protect their economies. Strategies being considered include diversifying trade partners, increasing local production, and seeking financial aid from international organizations. This trade dispute has brought into sharp focus the complex relationship between the United States and the Caribbean. It underscores the need for a more balanced and equitable trade policy that considers the vulnerabilities of smaller economies. The most immediate and tangible impact of the tariffs is the increase in prices. Consumers feel this effect almost instantly as they notice the cost of everyday items rising. From groceries to household goods, the price tags reflect the added burden of tariffs. With a 10% tariff on all goods imported from the Caribbean, the cost of these goods rises significantly. This tariff acts as a tax on imports, making it more expensive for businesses to bring products into the country. American consumers are now paying more for Caribbean products. This includes a variety of items such as tropical fruits, spices, and other specialty goods that are unique to the Caribbean region. This price hike affects a wide range of goods from agricultural products like bananas and sugar to manufactured goods and raw materials. The agricultural sector is particularly hard hit as it relies heavily on exports to sustain its economy. For Caribbean businesses, the tariffs present a significant challenge. Small business owners in particular struggle to absorb the increased costs, which can lead to higher prices for consumers or reduced profit margins for the businesses themselves. The increased cost of exporting goods to the U.S. market makes their products less competitive. This loss of competitiveness can result in decreased sales, as American consumers may turn to cheaper alternatives. This loss of competitiveness can lead to decreased sales, reduced profits, and job losses. The economic impact is felt not only by businesses, but also by workers who may find themselves unemployed as a result. The tariffs also increase the cost of importing goods from the U.S., further squeezing businesses and consumers in the Caribbean. This creates a cycle of rising costs and economic strain that is difficult to break. The construction industry is particularly vulnerable to these price hikes. Many Caribbean nations rely on imported materials for infrastructure projects, and the increased costs can lead to significant delays and budget overruns. Many Caribbean nations rely on imported materials for infrastructure projects. These projects are essential for economic development and improving the quality of life for residents. The tariffs have driven up the cost of these materials, leading to project delays and budget overruns. This not only affects the construction companies, but also the communities that depend on these projects for jobs and improved infrastructure. This slowdown in construction has a ripple effect throughout the economy, impacting jobs and economic growth. When construction projects stall, it affects a wide range of industries, from suppliers to service providers. The tariffs have placed a significant burden on the Caribbean people. Families are finding it harder to afford basic necessities, and the economic uncertainty is causing widespread anxiety. The rising cost of living is making it harder for families to make ends meet. Long lines at grocery stores and the need to carefully budget for essentials are becoming more common. Essential goods are becoming less affordable, and the economic uncertainty is causing anxiety and hardship. People are forced to make difficult choices about what they can afford, and this is taking a toll on their quality of life. The tariffs are a stark reminder of the interconnected nature of the global economy and the far-reaching consequences of trade disputes. The impact is felt not just in the Caribbean, but also in the United States and beyond, highlighting the need for thoughtful and balanced trade policies. In the midst of this trade turmoil, one part of the Caribbean remains unaffected, the U.S. Virgin Islands. This U.S. territory, acquired from Denmark in 1917, exists outside the U.S. customs area. This unique status exempts the islands from the tariffs imposed on other Caribbean nations. The exemption has significant implications for the U.S. Virgin Islands. While other Caribbean nations grapple with the economic fallout of the tariffs, the U.S. Virgin Islands can continue to trade with the U.S. unburdened. This advantage could potentially boost the island's economy, attracting investment and creating jobs. However, the exemption also highlights the complexities of U.S.-Caribbean relations. Some argue that the U.S. Virgin Islands' special status underscores the uneven playing field created by the tariffs. Others point to the historical and political factors that differentiate the U.S. Virgin Islands from other Caribbean nations. The exemption of the U.S. Virgin Islands adds another layer to the already intricate web of trade relations in the Caribbean. It raises questions about fairness, equity, and the long-term impact of the tariffs on regional integration and economic development. Guyana, a nation on the cusp of an oil boom, has found itself at the center of the tariff storm. This small South American country, rich in natural resources, is experiencing a transformative period in its economic history. The discovery of vast oil reserves has positioned Guyana as a significant player in the global energy market, attracting attention from major world powers. Initially slapped with a 38% tariff, significantly higher than the 10% imposed on other Caribbean nations, Guyana faced immediate economic pressure. This sudden imposition of a steep tariff created a ripple effect across various sectors of the economy, from local businesses to international trade relations. The higher tariff not only strained Guyana's financial resources, but also raised questions about the motivations behind such a decision. This higher tariff, later reduced to 10%, sparked speculation about its connection to Guyana's growing ties with China. As Guyana sought to diversify its economic partnerships, its increasing engagement with China became a focal point of international scrutiny. Analysts and policymakers debated whether the initial tariff was a strategic move to counterbalance China's influence in the region. Despite the initial tariff hurdle, the U.S. continues to import key resources from Guyana, including crude oil, which remains a cornerstone of Guyana's export economy. The oil sector, buoyed by new discoveries and investments, has become a critical component of Guyana's economic growth, providing substantial revenue and employment opportunities. Gold and bauxite. These natural resources are not only vital to Guyana's economy, but also to the global supply chain. The mining sector, particularly gold and bauxite, has long been a pillar of Guyana's economic landscape, contributing significantly to its GDP and export earnings. The U.S. also supports Guyana in its territorial dispute with Venezuela, adding a geopolitical dimension to the economic tensions. This support underscores the strategic importance of Guyana in the broader geopolitical landscape of South America. The territorial dispute, centered around the resource-rich Essequibo region, has been a long-standing issue with significant implications for regional stability and international relations. Guyana's experience highlights the complex interplay of economic interests, political alliances, and trade policy in the region. The country's journey through these trade tensions serves as a microcosm of the broader challenges faced by small nations in the global economy. Balancing national interests with international pressures requires astute diplomacy and strategic foresight. The Guyanese government has maintained that the initial higher tariff was not related to its relationship with China. Officials have emphasized that the tariff was a result of broader trade policy considerations and not a punitive measure against Guyana's diplomatic choices. This stance reflects Guyana's commitment to maintaining sovereignty in its economic decisions. It has emphasized its commitment to open markets and fair trade practices. Guyana's approach to trade is rooted in principles of transparency and mutual benefit, aiming to foster a conducive environment for both local and international businesses. This commitment is crucial for attracting foreign investment and sustaining economic growth. However, the episode underscores the delicate balance Guyana must strike as it navigates its relationships with both the U.S. and China. The country's strategic location and resource wealth make it a key player in the geopolitical chessboard, necessitating careful management of its international alliances. Guyana's ability to leverage its resources while maintaining diplomatic equilibrium will be pivotal in shaping its future. Guyana's situation serves as a cautionary tale for other Caribbean nations seeking to diversify their economic partnerships. The experiences of Guyana highlight the potential pitfalls and opportunities that come with engaging with emerging global powers. Caribbean nations must weigh the benefits of new alliances against the risks of economic and political repercussions. It highlights the potential risks and rewards of engaging with emerging global powers while maintaining strong ties with traditional partners like the United States. The evolving dynamics of global trade require nations to be agile and strategic, ensuring that they can navigate the complexities of international relations while safeguarding their economic interests. While the focus often rests on the raw materials and commodities affected by tariffs, the Caribbean's tourism sector has not been immune to the economic ripples. The imposition of tariffs by the USA on various Caribbean goods has had a cascading effect on the region's tourism industry, which remains a vital pillar of many island economies. Before the tariffs, the Caribbean islands were enjoying a steady influx of tourists drawn by the promise of pristine beaches, vibrant culture, and unique experiences. However, the economic strain caused by these tariffs has led to an increase in operational costs for local businesses, from hotels to restaurants and tour operators. These increased costs have, in turn, been passed on to tourists, making vacations to these tropical paradises more expensive. The higher prices have deterred some potential visitors, leading to a noticeable decline in tourist numbers. This reduction in tourism has hit the local economy hard. For many Caribbean nations, tourism is not just a source of revenue, but a lifeline that supports countless jobs and businesses. The decreased tourist footfall has resulted in lower income for local vendors, reduced occupancy rates in hotels, and fewer bookings for tour services. The ripple effect extends to other sectors as well, including transportation and retail, creating a challenging economic environment. Local businesses have voiced their concerns, expressing frustration over the dual impact of tariffs and the resulting downturn in tourism. Many small business owners, who rely heavily on tourist spending, have reported significant losses. The overall sentiment among these entrepreneurs is one of uncertainty and apprehension. They worry about their ability to sustain operations and support their families in the face of prolonged economic pressure. Despite these challenges, the Caribbean islands remain resilient. Efforts are being made to adapt and innovate, with some businesses focusing on enhancing the quality of their offerings to attract high-value tourists. Governments in the region are also exploring new markets and strengthening ties with other countries to diversify their tourism base. The situation underscores the interconnectedness of global trade and local economies. The tariffs imposed by the USA have far-reaching implications, affecting not just the export of goods but also the flow of tourists and the health of the local economy. As the Caribbean navigates these turbulent waters, the resilience and adaptability of its people will be crucial in shaping a sustainable and prosperous future for the region.